Saturday, February 3rd, 2018, Monaco 64, home of alternative economics and contrarian views. So are we going to be watching paint dry, as Janet Yellen said, about quantitative tightening and unwinding the balance sheet? Or are we going to watch a train wreck? If we look at what happened yesterday, it looks a little more like a train wreck. I don't want to get ahead of myself, but we need to look at what happened in the stock market and the bond market. The bond market, of course, I've been warning people for the last few weeks, even the last year or 18 months. I have worked in the bond markets. I worked in the bond markets for over 20 years. So, and I have said in the past recently that unless we see interest rates spiking really quickly, everything might stay under control. So what happened yesterday? Well, the Dow was down 665.7 points. So if you round that up, that's 666 points, which is quite interesting because the number 666, of course, is usually associated with the Illuminati, the New World Order, the number of the beast. And even if you look on Wikipedia, it says 666, the number of the beast, is described in Revelation. The book of Revelation is titled The Apocalypse of John. And interesting that we dropped 666 on a day where President Trump allowed this FISA memo to be published, and a lot of stuff is now coming out, and kind of a revelation. It's weird. You know, reading here, Zero Hedge this morning, it says GOP reps seek criminal prosecution of FBI, DOJ officials for full-throated illegal misconduct and treason. Nunes, FISA memo just phase 1, now targeting State Department in phase 2. So very interesting. 666 from the book of Revelation, number of the beast, and that's how much the Dow fell yesterday. Of course, gold and silver were hammered yesterday, silver particularly, but I'm not concerned. I think it's only short-term noise. I'll show you a few charts later on of what's happening and what happened in the past when interest rates spiked a lot higher and the Federal Reserve lost control of longer-term interest rates. The Federal Reserve can control short-term interest rates, but longer-term interest rates is a bit more difficult unless they backtrack now and say that they're gonna, instead of unwinding QE, they're gonna do more QE, and then they'd lose complete credibility. The other interesting thing about yesterday is that yesterday was the last day for Janet Yellen. Well, today's the last day, but yesterday was the last day that the markets were open under her leadership of the Federal Reserve. On Monday, February 5th, Jay Powell will take over as chairman of the Federal Reserve. So she left on an interesting note, spiking interest rates and crashing stock market. The mainstream media is saying that the reason the stock market fell off and that yields are rising quickly in the States is because of pace surge raises fear that the Fed was slow off the mark. And I even bought this paper, which I usually don't, the FT, and you can see there. So they're basically, and I'd have to say the FT is a mouthpiece of the Keynesians and the City of London and Wall Street. So they're basically blaming the fear of inflation on pay rises, which is totally bogus because in the classical sense, inflation is a purely monetary phenomenon. When you print too much money out of thin air, money that's not backed by savings or production, you devalue the value of that currency or of that money. And rising prices or rising wages is only a consequence of inflation. It doesn't cause inflation. It's like saying, you know, that the wet pavement or the wet sidewalk caused the rain. No, the wet sidewalk or pavement is a consequence of the rain. So, and that's how they've been getting away since the early 80s, since, you know, the Keynesians took over and the Wall Street, City of London, the central banks. They've been trying to fool people into thinking that inflation is their measures of inflation, like CPI, and not that it's money printing and the fact that their balance sheets have ballooned by trillions of dollars. That's what is going on. So yeah, I'm not surprised by this headline by the FT. And I'll probably read a little bit later on to see what they say, but I'll take it with a huge chunk of salt, not grain. What else? Well, bond markets. Yeah, I've spoken recently of how that 263 yield level was really important, and we've been, we've had a double top there a few years ago, and recently we broke through that level. So I'll show you the chart here of the 10-year yield. So you can see there, it was late 2016, and last year we touched that 263 level. There you can see there's like a double top. And most recently now, in this year, we've finally broken through that 263 level. And I said the next target will be 275. And lo and behold, a few days ago, I think it was Thursday or Wednesday, we touched 275 and it came straight back down. But then yesterday, it just blew right through 275. And as you can see, we closed at 284. Now the next important level is the 3% or just above 3% there. You can see that was the high at the end of 2013. So over 4 years ago. And why are interest rates so important, especially on the 10-year note? Well, because interest rates are the price of money. The U.S. Treasury is the benchmark for all government debt in the world. It's what backs the fiat dollar, aside, of course, from oil. But it's the government bond that, the more government bonds you print, the more money there is out there. And yes, all other assets in the world, be they stocks, commodities, bonds, corporate bonds, private equity, everything is priced off the 10-year yield. So if the price of money starts going up too quickly, it disrupts all the financial calculations by investors, traders, governments especially. They're going to have to pay a lot more to borrow. And since 1981, though, and don't forget that bond markets, when the prices of bonds go down, the yields go up. So yields going up, not a good thing. Every basis point higher in Treasury yields means that the U.S. government is going to pay 1 basis point more to roll over existing debt, to issue new debt. And we all know how profligate the U.S. government has been for the last 50, 60 years, and nothing has changed under Trump. But they've been able to keep control of the bond market, the central banks, the bullion banks, the investment banks. And how have they done that? I think a lot of it is through manipulation, through brainwashing of the economic profession, changing the definition of inflation and manipulating the statistics like CPI, and the use of derivatives as well. Bond derivatives, bond futures, interest rate swaps, And here's the most important chart, I think, for the whole financial system is the 10-year yield. And we can see that from 1976, it bottomed just at the end of 76, it bottomed just below 7%, and then it spiked almost to 16% in the early 80s. And that was when gold went from $100 to $885, because the Fed lost control there of the long end of the yield curve. And so to all those people who say that if interest rates go up sharply, it's going to be bearish for gold, think again. But then here's the, and then since the 1981, we've had this bull market in bond prices, but it has been a bear market in yields because as bond prices go up, yields go down. It's an inverse relationship. And as you can see, that channel that I drew there, we've broken out of that channel. And the other interesting thing that you can see is that since 1981, we've had lower highs and lower lows, all the way even to July 2016 when we had the low around 132. That was lower than the previous low, just by a little bit, but it looks like a double bottom. But now, that's why the 3% level that we saw earlier is so important, because if we break this 3% and we're only 15 basis points away from there, and 15 basis points is nothing now. If we break through there, you could see, I don't think we're going to be watching paint dry, to put it another way. And the Fed now is completely boxed in because they promised that they're going to start unwinding the balance sheet, which will mean selling treasuries that they have, in the balance sheet. I think they're going to be selling like 600 billion from October this year to October 2019. You have the Chinese probably, not buying as many treasuries. We had a comment a few weeks ago from a Chinese official that they could stop buying treasuries. So, so who's going to be buying those treasuries? So, and if the Fed backtracks and says, oh no, we're not going to do this, we're going to start doing QE again, they will lose all credibility. So let's have a look here at the other concept that was completely broken yesterday. Because usually in the last 15, 20 years, when stock markets crash as they did yesterday, the Dow was down 666 points. I know percentage-wise it's only 2.5%, but I think it's the biggest move since Brexit. So that's June 2016. It was about time the stock market corrected. But yeah, this concept of flight to safety, that when stock markets crash, people flee towards treasury bonds. I'll show you what happened in 2008 during the Lehman crisis and the stock market collapse. So I'll first show you the stock market here. You can see beginning of August, we were almost at 12,000 in the Dow. And by early 2009, around early March, we dropped to 6,600, I think, 6,500. So, lost 50% of its value almost, the Dow there in those, from August to March 2008, 2009. And look what happened to the Treasury bond, Treasury, the 10-year note future. And it says March 2018, but that is like the near month. So you can see there from August 2008, it went from 115. And then by the time we were in March 2009, it had spiked to almost 127. And it also went up to over 130 just before the end of 2008. So that was flight to safety. And now we're seeing the opposite. We're seeing bond prices collapse, and we're seeing the stock market collapse, which is not a good sign. It's basically saying that the old relationships are dying. So are we witnessing at the end of the bubble of everything? Maybe, because it has been interest rates going down like they have since 1981. That's inflated this asset bubble, financial bubble that we've had since 1981. You know, when Reagan took over, I think the national debt in the U.S. was just under $1 trillion, 960 billion or something. And now we are at over 20 trillion. The Dow, 1980, I think around that time, bottomed around 800. It had made a top at 1,000 in 1966. And now recently we went up to 26,000. Interest rates dropped from 16% almost 10 years and dropped to 1.3 in July 2016. The only thing right now that is really undervalued are the commodities. You look at the commodity charts, they're really undervalued. The mining stocks, gold and silver. I mean, silver was at $50 in 1980, and we're just below 17. I know gold is above 887.50, which is the high in January. But I think, yeah, it's going to be an interesting next few weeks, next few months. We'll have to see what happens on Monday. This 666 is very interesting, I have to say. The other thing I'd like to look at right now, just before I finish, is the cryptocurrencies. We dropped, I think it was yesterday, below 8,000. We almost touched that 100-day, 200-day moving average, and we bounced off that average. So maybe the bottom is in, I don't know, or maybe we could still be, might go up more and then correct further down. But I think longer term, everything's still fine for the cryptocurrency. So right now, Bitcoin is at above 9,000, so it's recovered well, 9,300. Ethereum is almost back to 1,000, it's 977. EOS traded below 8, and it's now 1030. So that's what I wanted to cover. There are some other interesting news out there. There's an interesting article I recommend people read on Zero Hedge today. Is by Nomi Prinz, ex-Goldman Sachs employee, and she says Nomi Prinz fingers Trump's financial arsonists. And she says, next financial crisis, not if, but when. She goes through all the people Donald Trump hired, you know, Treasury Secretary, Office of the Controller of the Currency, SEC, and it's very interesting to, you know, she's basically saying that Trump is letting Wall Street run riot again, and that usually leads to trouble. So yeah, I highly recommend that article. It's not that short, but yeah, it's on Zero Hedge. I'll put the link below in the description. So if you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet, and you can also follow me on steemit.com and on Twitter. And I'll talk to you later. Bye.